Hello and welcome to another episode of Full Court Finance here at Zacks. I'm your host, Ben Rains. And today we're taking a look at 3 retail stocks to consider buying amid inflation and the current market sell-off. But before we get into everything, remember to subscribe and leave a review wherever you listen to your podcast. And make sure to check out our new Zacks.com/promo page for a look into some of our services, portfolios, and more. So before we jump into the 3 retail stocks consider that are all going to be reporting in the next week/month, we'll do a quick market recap to give us a better sense of what's going on. So Wall Street has been selling really all things remotely growth related in most stocks outside of the oil and energy sectors as it prepares for higher interest rates to help combat 40-year high inflation. So we've seen the S&P 500 fall now over 17% in 2022. It's down about 3% in the last 12 months. So it's at new lows over the last year. The tech-heavy NASDAQ has now dropped 13% in the last 12 months, and it's down 27% in 2022. So these substantial declines are likely having many investors really nervous and wondering when it's all going to stop. Maybe they're just on the sidelines. That's up to your own prerogative, but you can never really call a market bottom. So we're going to look at some stocks that are worth considering, especially amid what we saw was another pretty high CPI. In April, it came in at 8.3%. So inflation was at 8.3%. It was down slightly from that 8.5% in March. But we're now seeing sky high prices kind of leaping over into the other areas of the consumer spending. So prices for groceries, dining out, air travel, and other services are all climbing. We saw airfare surge huge last month. So just prices are rising, and maybe people are going to start being a little more conservative and thinking about slowly backing out of maybe eating out all the time or going out. We'll see. But these stocks we're going to look at today are pretty fairly valued, and they're also, as I said, retail plays that are going to be good for the current inflation. They were good during the pandemic, and then they'll be good for years and years to come because they're pretty stable businesses. And we're going to get into that first one, and that is a company that everybody knows, and that is Target, which trades in the ticker TGT. The company posted really strong fourth quarter results at the start of March, and it flexed its muscles amid all those rising prices and supply chain setbacks. And now its first quarter results are due out on Wednesday, May 18th, so next Wednesday. So we're just going to run through all things Target. So consumers continued to flock to Target during the pandemic, and then obviously they continued to go there as restrictions started being lifted. It's going to be a one-stop shop for years and years to come. They've beefed up their e-commerce options. And all of this saw Target's 2020 revenue surge 20%, and then 2021 climb another 13%. So it pulled in $78 billion in 2019, and then it pulled in $106 billion in 2021. So a massive jump in those 2 years as everyone was just saying, hey, this is a great place to do pretty much all of my shopping. So we saw comps grow 13% in 2021 on top of 19% comps growth in 2020. Comparable traffic was up 12% last year. So people are headed back to the stores as well. All 5 categories of their merchandise were delivering double-digit comparable sales growth in 2021. And as I mentioned, they're just continuing to roll out various offerings, same-day delivery, in-store pickup, shipped. They want people to be able to order anything they want from Target, however they want. They would come into the store, shop around, anything you want. That's the new goal of not just e-commerce, but on-demand commerce, however you want. And that's what Target and other stores like Walmart are doing as well. The company's offerings that are their in-store brands are also really attractive. That helps with their margins as well. This is for everything from furniture and fashion to food and beyond. So this is why its operating income margin is really strong compared to many other retailers. It came in at 4.8% last year. And we saw also its adjusted earnings soar 44% in 2021, just to showcase the strength of its business amid all these other broader economic setbacks and rising costs. So looking ahead, we can see in its growth numbers or growth projections that all of these various offerings and its push into e-commerce and delivery are really going to continue to pay off. So after 2 back-to-back years of massive growth, Zacks estimates are calling for another roughly 4% revenue growth, all the way up to about 110 billion, and then another 5% growth in 2023 is what we're calling for. And then on the bottom line, we're calling for another 8% adjusted earnings growth this year, and then another 9% next year. So just steady growth in 2022 and 2023 on top of what were 2 blowout years boosted by COVID. And then in terms of their earnings estimate revisions at Target, we've seen a lot of positivity overall since it's before it reported its fourth quarter earnings. It's up big, and then we've seen some positivity recently, even in the last 30 days for both its 2022 and 2023 earnings estimates. And the company has a really solid history of quarterly earnings beats, including a 12% beat last quarter and about a 21% average positive beat surprise over the last 4 quarters. And then overall, its bottom line positivity helps Target land a Zacks rank number 2 buy right now. And then along with all of this, the company has really, once again, been able to flex its fiscal stability and confidence. It raised its dividend by 32% last summer. This helps its current dividend payout of 90 cents per share. That's yielding about 1.65%. This tops the S&P 500, tops Walmart, it tops its industry's 1% average. And then in terms of performance, that dividend yield looks even more impressive. So the stock has climbed 345% in the last 5 years. This crushes Walmart's 115%, Costco's 200%, and even Amazon, which is only up 125% now in the last 5 years. This run includes a big jump in the last 2 years. It's up about 90%. The stock is down 5% in 2022, but this looks a lot better compared to the market's 17% drop and its industry's 31% decline. The last time I looked Thursday morning, the stock was up about 1.8%, trading at around $217 per share, which is still nearly 20% off its records. And these levels give it 26% upside before we run into its current Zacks consensus price target. The stock is also trading right near its year-long lows in terms of valuation. It's trading at 14.3 times forward 12-month earnings, which is actually close to its initial COVID sell-off lows and beneath its 5-year median and 44% below its highs. And then Wall Street also remains really high in the stock. 13 of the 17 brokerage recommendations that we have are at strong buys, with nothing below a hold. So obviously with the company set to report its results next week, we've seen some giant swings in one day after reports. I mean, you saw Amazon and big stocks make big moves. So if you're a little nervous about getting into a stock right before earnings amid all the volatility, maybe wait until after the report. But overall, Target is a good bet for years and years to come. It runs a really stable business, a growing business that's going to do well both in bull and bear markets and recessions and however the economy is, because it's a one-stop shop for people's needs from everything from food to groceries. And they have a lot of low-priced, high-end feeling store brands that are going to help it grow for a long time. And we should note that it's a retail discount stores industry is in the top 23% of over 250 Zacks industries at the moment. And now we're going to move on to another U.S. retail giant, and that is Kroger. It goes by the Kroger Co. officially, but the stock trades under the ticker KR. So the stock soared to new highs after it posted strong fourth quarter results in early March and offered really solid guidance as it adapts to supply chain bottlenecks and rising prices. The grocery chain powerhouse has thrived during the heart of the pandemic, which is now thankfully behind us, and it's also now benefiting from more price-conscious shoppers who are trying to eat out less amid the 40-year high inflation that we've talked about. And this is something that the company referenced directly in their fourth quarter earnings call. We should also note that its digital and e-commerce efforts are once again continuing to help it drive growth, and Wall Street might be set to keep buying Kroger during the current market for its stability, dividends, and more. So we're going to get into all of that. So Kroger is the largest supermarket chain in the U.S. and one of the biggest in the world. The company operates under multiple brands across roughly 35 states, has over 2,700 supermarkets in multi-department store locations. Many of these Kroger stores feature pharmacies, Some feature gas stations. So sort of like the one-stop shop for just groceries and pharmacies instead of where Target, you can get all of that plus a TV and clothes and stuff like that. So we should also note that brick and mortar is really far from fading away in some aspects of retail, with grocery shopping obviously being sort of at the top of this list of things that brick and mortar or brick and mortar is not dying in the grocery space. And Kroger, of course, though, has spent years working to improve and beef up its e-commerce business like everyone else. This includes online pickup and delivery and everything. We should also note that Kroger is actively building out its network of high-tech warehouses and fulfillment centers. And the company also operates dozens of food production and manufacturing facilities to help produce its own private label products that help provide that value to customers and boost its margins, which is key at all times, but especially now. We should also note that shopping patterns benefit Kroger and others during the pandemic are continuing to help people like Kroger and stores like Kroger, as people are now being a little more conscious about maybe I don't want to go out eat as much as I was before with everything being so expensive. So with this in mind, its sales climbed 8% in 2020. And then as the pandemic faded, Kroger then benefited, as we mentioned, from all those rising costs. So its 2021 revenue then climbed another 4% to about $140 billion, with its digital sales up 113% on a 2-year stack. The company is also able to pass on some of those higher costs it's been running into onto its consumers, with its adjusted earnings also up 6% last year. And the Cincinnati-based chain's same-store sales were up 4% in Q4 and up 15% compared to the fourth quarter of 2019. We should also note that the company's fourth quarter earnings were up 12% to help blow away the Zacks consensus estimate by 25%. That big bottom line beat is part of a 22% average outperformance in the trailing 4 quarters. So like Target consistently beats on the bottom line, and it's beat by a fair amount recently. Crucially, Kroger also upped its 2022 guidance as it sees customers flocking to its stores. And it's also poised to keep successfully navigating these rising costs across the entire supply chain while methodically and strategically raising its prices. Kroger's 2022 consensus earning estimates soared 10% since its last report, with FY 2023 up 11%. And the company said that shoppers more than ever are gravitating towards its higher margin and lower price store brands, which is good for Kroger. And they also even said last quarter on their earnings call that they're seeing many more customers using coupons and anything to save money. And they did say, though, which is a positive, that last quarter the Kroger executives said they are seeing inflation moderating and expected to slowly moderate in the back half of 2022. Obviously, it's facing tough to compete against years, just like Target and all these other retailers. Still, Zacks estimates call for its revenue to climb about 2.4% both this year and next. And then meanwhile, its adjusted earnings are projected to pop about 2% on top of last year and the year before that, and then another 5% in 2023. And then longer term efforts and some fundamentals to consider that could help it in the long run, even though it might be kind of counterintuitive. Kroger is actively raising its wages to help it compete for talent alongside the likes of Target, Amazon, and Walmart, and many others who are raising their minimum hourly payment for employees. So in order to get the people who are going to be beneficial to working at your stores, Kroger is doing the same thing. It's also upping its efforts to fight against food waste and hunger, and it's actively attempting to improve quality and address issues such as animal treatment within its supply chains. As I said, these might raise costs, but I think in the long run, it'll help improve the company over an extended period of time, just those two efforts alone. And Wall Street's clearly getting behind these broader goals because Kroger's actively boosting its dividend and buying back stock while doing all of these things. So if the company was struggling and doing these things, no one would be very happy about that. But its current 21 cents per share quarterly payout is up 17% year over year, and it's now raised its dividend for 15 years in a row. And it plans to deliver strong and sustainable total shareholder returns of 8 to 11% over time while deploying its free cash flow to other efforts. Kroger's yield sits at about 1.5% at the moment to match Walmart. And then some of some of these fundamentals, obviously, and then some things we're about to touch on are a big reason why Kroger was a target of Warren Buffett and Berkshire Hathaway, and they bought the stock back in the fourth quarter of 2019, and it's paid off in a big way since then. So along with the dividend, Warren Buffett and Berkshire were gravitating towards valuation and its ability to, as I said, continue to grow kind of no matter what's going on in the economy. Kroger shares have easily outpaced its highly ranked, I shouldn't say highly ranked, its retail supermarkets industry over the last decade, up 500% versus 188%. This also tops the S&P 500, it's 315%. And this does include a pretty big downward stretch, but it's now ripped off 130% growth in the last 3 years. And Wall Street is jumping heavily back into the stock over the last 3 years. And then in the last 6+ months has done really well, as well as the tech trade fades and investors really are clamoring for value and dividends. So the stock's up 23% in 2022 alone versus its industry's 4% climb. And then obviously this compares really well compared to the broader market's big downturn. This does include a pretty big post-earnings release jump that saw it set brand new highs in early March. Kroger then inched higher after that run, but it's now trading about 10% below those recent highs at around $55 per share. And then in terms of valuation, it's trading at 14.5 times forward 12-month earnings, which is over a 30% discount to its industry, 30% value to that broader Zacks retail wholesale sector as well. And then on top of that, and even better, Kroger's trading 25% beneath its own highs and not too far above its median over the last decade. Kroger has also, as I mentioned, their bottom line outlook has improved. This helps it grab a Zacks rank number two, strong buy at the moment. And it really does seem like a solid candidate amid the rising prices, some economic turmoil, possibly in the continuing with just rising prices, which are slowly rippling through the economy even more. We could see more supply chain bottlenecks with the COVID zero lockdowns in China that are not even really being felt necessarily at the moment just yet. So it's definitely worth considering. And its next quarterly results are due out on June 16th, so the middle of next month. And then we're going to go way beyond Kroger and Target to a much smaller and more, I guess you call it niche, but not really niche, but it's a store I've never been to. I don't even think I've actually ever seen one of these stores, but that doesn't mean the stock is not very good, because it is. And the last stock up we're going to talk about is The Buckle, or Buckle. I've seen it referred to as different places, but technically the company is called The Buckle. It trades under the ticker BKE. Its quarterly results are expected out on May 20th, but the company is yet to confirm that. So The Buckle is an apparel and footwear retailer that operates across most of the U.S. The company posted a really banner year in 2021, and its outlook is solid as customers gravitate towards its competitively priced denim and beyond. So on top of that, the company runs a really financially sound operation, pays out a dividend yield is really high at the moment, and that helps it make pretty attractive considering everything that's going on. So overall, Buckle is a retailer that's focused on what it calls better priced offerings. So discounted clothes, lower price clothes for apparel, footwear, accessories. As I said, it got really famous for its denim. It's a Nebraska headquartered company, operates roughly 440 stores across over 40 states, which are located with indoor and outdoor malls, mostly, though they have standalone stores as well. The company's offerings can go from everyone to kids to adults, spanning from private labels to brand names. As I said, they sell denim, sportswear, outerwear, boots, kind of anything you could think from footwear to apparel wise. The company also boasts that it's known as a denim destination. So for its customers, it's clearly somewhere they're going to keep going back to. And they also provide perks such as alterations and frequent shopper programs. So that's going to attract more people going forward as well, especially if you're looking to save money at any turn. The Buckle went public back in the early 1990s, and it's posted year-over-year revenue growth every year outside of one tiny pullback. And then it fell on some lean years between 2015 to 2018, but then it started to get back on track in 2019 and 2020 before it posted a blowout 2021. So the company's revenue soared 44% last year to $900 million, from $900 million to $1.3 billion, which was a new company record. The company's comparable store sales matches overall top-line growth, with online revenue up 16% to account for about 17% of total revenue, so also growing its e-commerce presence. The retailer's bottom line performance is even better. Buckle's adjusted earnings soared 94% last year in 2021, and it topped our Q4 earnings estimates on March 11th by about 15%, and it's now topped by an average of 45% in the trailing 4 quarters. So all 4 of these stocks, or 3 of these stocks, have been able to easily beat in the last year as part of a longer history of bottom line beats, which is always a good sign, especially as recently we've seen a lot of companies underperform earnings estimates. The company's 2022 consensus earnings estimate is up about 9% since that release on the back of solid guidance. Buckle is now projected to follow up its great 2021 with 9% higher sales in 2022 and 2% stronger adjusted earnings after that blowout year last year. And the company's then expected to post more growth in 2023 on both the top and bottom line as well. And then this might also be really attractive to investors. The Buckle flexed its financial strength in December when it announced a $5.65 per share special cash dividend. So you already missed out on that, but that just shows how strong the company was and is. The company also raised its quarterly cash dividend by 6% to about 35 cents per share. That current payout is good enough to yield about 4.5% at the moment. That blows away the 10-year U.S. Treasury. Many companies in the S&P 500, many of its retailers are getting nowhere close to paying it 4.5% dividend yields. And it's even better because this dividend yield is not artificially inflated by a falling stock price. The stock's up about 200% in the last 2 years to outpace its industry's 30% climb. And then if we look back over the last 5 years, its shares are up about 225% versus industry's 43% downturn, and the S&P 500's 90% climb. The stock is now down about 11% in the last 12 months, though, including a roughly 30% drop since November, which is when the NASDAQ first started to decline. So this got caught up in some of that growth-focused selling. It's trading at around $32 per share at the moment. The pullback, though, coupled with Buckle's strong earnings outlook, has it trading right near decade-long lows at 5.7 times forward 12-month earnings. This is a 40% discount to its industry and even stronger value to the broader Zacks sector. Buckle currently lands a Zacks rank 3 hold right now, alongside A grades for growth and value on our style score system. It is worth noting the stock is somewhat heavily shorted, which might deter some investors, but the fashion retailer still sits on a strong balance sheet alongside many other pretty appealing qualities during the current market and economic environment, from its value to its dividend. We also saw the stock jump 6% last time I checked on Thursday morning, so it's certainly worth considering this lower priced retailer amid all of this. But as I said, the current market, maybe you want to wait until after they post their next results for all 3 of these stocks. And as I said, the company is yet to confirm its exact quarterly earnings date. So that does it for another episode of Full Court Finance. Until next time, I'm your host, Ben Rains. And remember, if you have any questions, please feel free to shoot us an email over podcast@zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.